Hello and welcome to Rajya Sabha Television. You're watching a brand new edition of Policy Watch with me, Frank Pereira. The Monetary Policy Committee maintained status quo on policy rates and stance in its December policy review in line with expectations. Financial markets were keener on MPC's macro forecasts and policy guidance. MPC maintained its FY18 growth forecast at 6.7% GVA, while nudging up its H2 FY18 CPI forecast to 4.3 to 4.7%. In terms of guidance, MPC reiterated data dependency while citing upside risks to inflation and persistent slack in the economy. On this edition of Policy Watch, we will discuss the RBI's monetary policy review. Joining me on the program today are R.M. Mallah, former CMD IDBI Bank, K. Badarinath, the policy editor of the Financial Chronicle, and N.R. Bhanumurthy, professor, NIPFP. Thank you to all my guests for joining me on this edition of Policy Watch. Professor, I'd like to begin with you. Of course, the RBI has not changed the repo rate. No status quo remains in yet another policy review. Are you surprised at all by this?
No, I think this is on expected grounds. The way the RBI is reading the inflation numbers, it's clear that there are some inflation expectations picking up over a period of time, and in fact the forecasts also show that the inflation is going to be slightly more than what their October reading is, and they have very clearly specified what are the reasons behind these higher expectations. And at the same time, I think the second quarter GVA numbers seems to have supported their status quo. In a sense, there is a clear recovery in the overall GDP path. We know that I think the 6.3 is going to be revised upwards, and if you have looked at the post policies discussion, I think RBI also says that Q3 and Q4 they expect a GDP of 7% and 7.8%.
Yeah.
So which is a substantial revision upwards in the overall GDP numbers, and I think for the whole year 6.7 in my view is realistic, although I would have expected a slightly higher growth than 6.7, close to 7%. Given that kind of a scenario, my guess is that the holding on interest rates was the right measure, and I think the market is really waiting not for the interest rate cut, but they are only waiting for how the finance ministry is going to pan out this recapitalization program. They have already declared, but I think they are delaying. I think my view is that the finance ministry need to come with guidelines as quickly as possible and allow the banking sector to do this transmission mechanism much more effectively the way RBI would like to have, rather than waiting for the interest rate cut.
Sure. K. Badarinath, as far as the reasons given by the RBI this time around for not cutting the interest rate, do you believe that they are valid? Because as far as the MPC goes, there was one member who wanted a rate cut this time around too by 25 basis points.
Yes. There are two issues in this. One is the banks have not passed on the full, the benefit of the past rate cuts to the consumers. They have their own problems like the non-performing assets. They have to, make higher provisioning, and they have to still keep their both bottom line as well as top line intact and things like that. So my guess is that could be one reason why they would not have. And in fact, if you see the RBI governor's, statement, he says that look, first pass on the entire thing to the benefit to the customers. Then we can think of one more cut. I'm okay with that. But point here, he also maintains that the further cuts will depend upon what will be the data points that I will get in the next few months. Unless I have these data points, I will not be able to do it. So but at the same time, there is the person who had, one of the members who had, wanted rate cut. His argument is that look, don't wait for that to happen. Do it now. And so that already there is a little nascent, pickup in the credit offtake. So this will give a bigger boost. And the investment cycle has to pick up so that your consumption patterns will increase, both for the consumers in the products as well as services category. The lending activity has already started picking up, though in a very small way. But this needs to hasten up. If you want to reach the 7% growth that Bhanu is talking about, then perhaps maybe I thought he could have taken a call saying that, okay, I'm cutting it now, go for a 25% cut, take the risk associated with it.
Professor Bhanumurthy is shaking his head in disagreement. A quick counter from him, and then I'll go to Mr. Mallah, who's been waiting patiently.
Channel, I mean, we all know for the past 4 or 5 years, the interest rate channel has not really worked. I think that needs to be kept in mind. In fact, the high growth period, I keep giving this example, the high growth period from 2002 to 2007, we have seen the interest rate going up, and we also seen growth is going up, investment rate going up. So in a sense, the point I'm trying to say is that the interest cost of the overall production activity is just less than 2%, but the inflation cost is much more than 10-12%. So if the RBI, whatever way it is, if they can control the inflation at 4%, that is going to be much more useful for the production activity rather than just tinkering in 25 basis points here and there.
You can counter him, Mr. Badarinath, but first let me get Mr. Mallah into the picture as well. He's been quietly listening to what both of you all have to say.
It's great to listen to professors.
Mr. Mallah, let's talk about this issue of the interest rate cut not being proportionately passed on to the consumers by the banks. Why hasn't that happened? And do you believe that that will happen anytime in the near future?
See, let me give you the perspective of a bank. What constitutes the cost of a bank? And we must also understand what is this repo rate. The repo rate is simply a rate at which banks can borrow from Reserve Bank of India, sort of a lender of last resort. There is another facility which is at 6.25. Whereas banks' cost comprises of the rate of interest which they give on savings bank, and then fixed deposits, and then there are certain negative carry. For example, 4% has to be kept with the Reserve Bank of India for all deposits. So that constitutes a cost of a bank. And then adding the margin and maybe providing for NPAs, that becomes its base rate, which again is a matter of discussion whether base rate should be on average or it should be on marginal cost. And that constitutes the rate of lending by a bank. Now, a question has been raised that it been passed on, but I am also privy to the circumstances when Reserve Bank was raising the rate of interest, the banks were not raising the rates of interest. So now the freedom has been given to banks to fix the savings bank rate of interest. There are only a couple of banks which they have decreased to 3.5%, but still the average cost of banks is more than 6%. Now adding 2.5%, so base rates are in the range of 8 to 8.5%. And I totally understand the view of industry trade that any capital investment decision has to be based on what is the financing decision. If the rate of interest is low, it actually motivates people to have more capital formation. But that is not the only thing. There are so many other things. For example, availability of land, availability of market, and availability of that. I am of the firm view that this decision of Reserve Bank, which was 5:1. 5 eminent economists felt that rate cannot be reduced for the simple reason that Reserve Bank's one of the most important objective is to control inflation. Yeah. And it is for the first time in our nation that we have decided 4 plus minus 2, 4 being the ideal. It is already crossing 4. And if inflation is more, it cheats larger number of people. And if we have to have a sustainable economic development, the inflation has to be pegged. But even if you see the 4% inflation, the people who are depositing money in savings bank and the rate of interest is 3.5 and 4, so actually they are getting no rate of interest.
Right.
So, if the banks reduce the rate of interest, they have to necessarily reduce the rate of interest on fixed deposit, which impacts a large number of people.
So, are you saying then that there is no scope for a rate cut as far as banks are concerned?
As of now, I firmly believe that the type of figures which we are emerging at data, for example, crude prices, what international central banks are doing. Right. So, this is not the time. And, credit has started picking up and banks are very innovative on certain areas. For example, housing loan, loans to micro, small and medium enterprises, loan to agriculture, which are priority areas for this nation. The rate has already been subsidized vis-a-vis others.
Okay. Yes, Mr. Badarinath.
I know that both the gentlemen are against the rate cut and things like that. But point here is, unless there is a consumption demand, You have to give a big push for the consumption demand. Without that, your economy is going for a 6. Secondly, even the inflation figures that the RBI governor talked about, in the last cycle, they talked about 4.2 to 4.6%. And you have given just 0.1% uptick in the inflation, saying that okay, 4.3 to 4.7%, which is still in manageable limits. And the overall, if the long term or the medium term goals you have taken, 4 to 6%. And we are at the lowest step today. And if you don't do it now, then if you don't push up consumption demand today, and fear, well, let us not create a demon out of inflation or anything.
No,
Always,
Let him complete and then you can quickly counter. Yeah.
most confirmed economists would say that a little bit of inflation is always good.
Okay, so the time is right at the moment is what you are suggesting. Yes, Professor.
I completely disagree with that argument. See, a little bit of inflation, good for whom? I don't understand. If you say that, all along, if you look at the history for the past 2 decades, RBI always tried to say that the optimal level of inflation for this country is 4%. Now we just have a band.
4 to 6.
It's a 2 to 6%. So it's okay, we have a band, just gives you leverage for the RBI to work within that. But still, the medium term to long term target of inflation is 4%. We still had it. So the point is, as Mr. Mallah already pointed out, 4.3 to 4.7 is slightly on the higher side. It's only forecast. Actually, last time when they said 4.2 to 4.6, now the reading is actually the inflation expectations are firming up further.
Sure.
So in the absence of that kind of forecast, if you say that I will reduce the interest rate, the inflation could have gone to more than 4.6 or maybe close to 5%. That's not what we warranted. In any case, the interest rate channel is not working. And I think we need to very clearly understand in India, it is the savings-led growth, not the investment-led growth.
Okay, sure. Quick closing comment on this segment from Mr. Mallah, and then we'll move on to discuss something else. Mr. Mallah, let's talk about this merchant discount rate. Now, the RBI has capped it. As a banker, I want to know what exactly it is and what does it mean for consumers or the common man like me.
You see, what happens is when we make digital payment, there are a lot of POS and other activities which take place, and it involves cost. Now, who should share the cost and what should be the cost? And, India is a free country, so there was freedom. So what Reserve Bank beautifully has done, that they have capped this cost, that it should not be more than a particular amount, depending on the value of transaction. So it's a very good step Reserve Bank has taken. It's a step in the right direction that it will encourage more digital payment, both at small rural outfits as well as the large outfits.
Which is the flavor of the season, digital payments
Absolutely,
at the moment. So you're pushing that and you're trying to ensure that digital India move or the push is towards that.
RBI is doing its bit.
Okay, RBI is doing its bit. All right, on that note, we'll take a short break now. On the other side, of course, we'll discuss the foreign trade policy with the same set of guests. Do stay tuned. We'll be right back.
This is Kibutu in Arunachal Pradesh, East Point East on the map of India. Kibutu is dangerously close to the Chinese pressure point. We see first-hand and unseen areas of sand dunes and see how BSF is guarding this difficult territory along the Indo-Pak borderline. We are now slowly entering into the interior-most parts of the Sarkirik area. Indo-Tibetan Border Police Force justifies each word of this thing. Watch super exclusive episodes of National Security Series only on Rajya Sabha television.
Welcome back. You're watching Policy Watch with me, Frank Pereira. The government on Tuesday came out with a market-friendly foreign trade policy. The move was announced after the 14-month positive growth streak was broken in October on account of confusions in the implementation of GST. Though the FTP was expected to be announced in July 2017 along with GST, it was delayed to accommodate feedback from the exporters. The government also announced incentives worth 8,450 crore rupees to boost exports of goods and services. The policy was clearly targeted at job creation, mainly at jobs that are generated from the smaller enterprise. FTP's measures are aimed at labor-intensive segments and the micro, small and medium enterprises, which will help increase employment generation and value addition in the country. Still with me on the program now to discuss the revised foreign trade policy are RM Mallah, former CMD IDBI Bank, K. Badarinath, Policy Editor, Financial Chronicle, and NR Bhanumurthy, Professor, NIPFP. Thank you, gentlemen, for staying with me on the program. You know, Mr. Mallah, I'd like to begin this segment with you now. What is the focus of the revised foreign trade policy?
See, essentially, for any country to grow and increase its GDP and per capita income, it's absolutely necessary that we should have exports. You know, it's very interesting to see even before, when we became independent, our part of the export within the global export was more than 10%. It kept on slowly falling down because we adopted a policy, maybe at that time it was good, that inward-looking policy. Let's protect our industry, let's keep imports out and become self-sufficient. Whereas some other smaller countries went on export-led growth. This realization came to India about 1990, but by that time our export among the global was only some percent. So gradually it is inching to 1.5, and we have taken an initiative that by 2020-22 we'll become 5% of international trade. It's a large figure we need to achieve. In order to achieve that, we must take care of our exporters. It is absolutely essential because export is not based on our market, it is based on global market. So a lot of play takes place. What is the cost of production? What is the exchange rate? Now, obviously, there are certain industries which cannot compete globally unless some incentives are given.
Sure.
So within the policy of 2015 to 2020, where our aim is to make twice our export, this step, which was taken 2 days back, is a very positive step. As you were saying, about 8,500 crore has been kept as 2% additional incentive to merchandise export sector, and there is also increase in service sector. But it has been given only to few industries. My suggestion would be that probably it should be given across.
Okay. You know, Mr. Badarinath, who stands to gain from the revised FTP?
In fact, the larger question is, should we have a trade policy at all? No, seriously, because if you recall, sir, Suresh Prabhu as railway minister had opted out of presenting a separate railway budget, and we merged it with the federal budget. So why do we need a trade policy every year just for optics and press conferences? I don't think so. Yes, all the measures that he has done are required, can be done. If investment policies can be taken or decisions can be taken by the cabinet, why not we do the same with the trade policies? And trade issues can be dealt with on a very quick basis and very fast. And in fact, the trade developments are so quick, you can't wait for the year-end policy or the mid-term policy for review. So my suspicion is that we should scrap the trade policy, merge it with the regular union budget, and any decision that needs to be taken should be taken suo motu on the everyday or on the day-to-day basis and see that it is done. But the issues that he has raised are very serious because labor-intensive sectors are given a lot of support, and this is a supportable policy. But my suspicion is we must go for bigger ideas.
Okay.
Because
and keep abreast with the times is what you're suggesting. Okay. You know, Professor Bhanumurthy, do you subscribe to the views of Badarinath?
Again, I would like to disagree with him for a change. The reason is, you cannot push everything to the finance ministry. Now we have closed the planning commission. The work has been given to finance ministry. Now we want to close the foreign trade policy you give to the finance ministry for that matter. So I think that's not, you see, we don't need to centralize everything in terms of administration. Having said that, this is very important for a medium term to long term planning, because 45% of the GDP is depending on the trade. I think if you look at the export plus import, it's close to 45% of the GDP. Given that kind of a size, that contribution it has to the GDP, I think there is a need for, having a little bit focused kind of a
some
policy.
kind of specialization.
And I think, to be fair to DIPP, has been doing well. Yes, of course, I don't know how much serious in the past, but if you look at for the past 1 year or so, there is some kind of a change in the way it's been looked at. And the reason why our potential GDP has come down from 9% to 7% is that because the focus on the trade sector has actually come down. Of course, as Mr. Mallah pointed out, it all depends on the external demand. And at the same time, we also need to have some kind of policy measures to really push the exports or the trade to that extent. But my problem with this foreign trade policy is that there's a large focus on exports alone. I think if you look at for the past 10 years or so, in fact, the import content on our exports is much more substantial compared to the pre-reform period. So given that kind of situation, I think we need to give priority to both exports as well as imports, such a way that, as I said, import-led export growth kind of things happening in many of the sectors. Take for example, gemcell jewelry, petroleum sector. We only have the reprocessing exports. So I think in that kind of situation, the trade policy should give priority on both exports as well as imports. And you rightly identified some of the sectors where labor-intensive sector needs to be given a lot of priority, because I think the employment generation is a very important aspect of this government. And at the same time, on the back of the whole policy, my guess is that this 25% is also must be playing a major role. Where the share of manufacturing needs to be increased to 25%. That is a long-term goal. So if you want to achieve that, I think the exports of manufacturing needs to be given a push. I don't know whether 8,000 crore is sufficient, but I think it also needs to bring in a lot of structural measures so that you become very competitive.
Sure.
Right now, I don't think India is very competitive in most of the products. Okay. We are only doing a back-end kind of value addition. In that sense.
Despite the fact that you have a trade policy every year, you have a 5-year trade policy, and you have a review every year. Despite that, the target we have set for ourselves is to double our exports, have at least 5% of the global export market for India. Where are we today? We set the target in 2015.
2015. April 2015 to 2020. Yes.
No, it was even before that. The earlier policy, also 2010 to 2015, when Mr. Anand Sharma was the Commerce Minister, he announced the first time that 5% should be our export share. But today we are at 1.7%. And you said we'll achieve our exports of $900 billion. Where are we today? Half of it.
What hasn't worked for us?
So what I'm trying to say is that, having a separate policy alone may not work. And if railways can work without a budget, why should we have a policy again and again? If foreign investments can come in without having a separate, setup for it, why shouldn't we have the Commerce Ministry to run it as it is? Or merge it with you can have a policy once in a while. Or you want to give it through an executive notification. I'm not saying that there shouldn't be changes.
Okay, sure.
That's a broader issue, but for any activity to go on, it's absolutely necessary that a policy has to be laid down. And for formulation of that policy, both, the users and the executors have to meet. So at least this is a forum where everyone meets, discusses, and global thing, and that it is
talking about the policy. Let's refocus our attention now on the policy for the next 2 or 3 minutes. The policy talks about new products and new markets. What can some of these new products and new markets be?
See, essentially, our exports to USA is the largest, and
that is because of the IT and software sector.
Yeah, and there is a huge. Let's focus for a minute on that. when Trump talks of made in America, what are the implications? When Trump talks of reducing the H-1B visa, how does it impact? And that's how you have the chief executive of this country trying to meet them and see the implications. The corporates in USA are absolutely clear. They would like to take the best at the lowest cost, which is India. And India can actually become the world capital for such activities, software. We have missed certain things, for example, the chip manufacturing and all that. I wish we could have become like Taiwan, and then we need not have imported anything for making mobile phone. Now we probably may become one of the largest mobile phone manufacturer after China and Taiwan, but it has large import because we don't make the chips. Now we shouldn't miss those buses, and we have to focus on export. And this policy and regular meeting and reviewing is going to do a great thing. And there are certain other things also. For example, recently this GST, the exporters get credit for input they have paid from that. Now, they still have to pay, and then they get reimbursement. Now, one thing is getting missed. In the system, what happens, an exporter has to block his working capital. Yes. And it doesn't come free. And the rate of interest is, of course, lower than others. But no one reimburses that cost. So all these things also can be ironed out through the policy changes. And at the same time, for example, agriculture is given certain incentives for loan.
Right.
And similarly, exporters should be given. And for the sake, I'll even urge that export financing should be part of priority sector.
Sure. One quick closing comment from Professor Bhanumurthy. As far as incentives are concerned, Mr. Mallah raised incentives a couple of times during the program today. What are the key sectors that are going to get these incentives?
No, I mean, again, I'll get back to the main focus of the trade policy itself. And I think that labor-intensive sectors, whichever it is, I think within the short term, my guess is that incentives are only meant for short term. I think for the long term, you need to have policies which can improve the competitiveness of the overall manufacturing sector.
Self-sustaining, basically.
Yeah. So I think, as they rightly pointed out, SMEs and agriculture sector, I think they need to be incentivized so that, the kind of policy shocks that they faced in the past 1 year, they will be able to manage themselves and, recover from the overall shock.
Okay. Yes. Quickly.
From the labor-intensive, low-cost exports are definitely important. But we should have a strategy and put in place an incentive mechanism where we go up the value chain. Because we cannot forever remain, just producing tomatoes and onions and export them, no?
Yes,
but
sure.
There's one difference. For example, exporting organic food, which has, you were talking about new products, India can master the art of organic food.
Okay.
And someone needs to brand it that this
organic.
It's growing.
Okay.
Growing.
All right. With that, then we'll call it a wrap on this edition of Policy Watch. RM Mallah, K. Badarinath, and R. Bhanumurthy, thank you so much, gentlemen, for joining me on the program and putting things into perspective for us. With that, it's a wrap. See you again next time.